Good morning, guys. Welcome to another lecture. It is the 2nd of June on Monday, and good to have you here. Hope you had a fantastic weekend. I do record these kind of almost back to back, not quite, but I do them sometimes on a daily basis. As a result, you're probably going to see this a couple of days in the future, but again, as long as you get the value, that's what matters. In any case, today we're going to do a few exciting things. For those of you guys who asked me questions in the comments, thank you very much. Totally appreciate you for using the comments as well, because I did say in my previous lectures that if you wanted to say anything to me, do use the comments. So if you want to ask questions, put in the comments. I will delete all spam from the comments. So if you wanted to make a comment about the audio quality, or you wanted to make a comment about something else that is like totally random, it won't show up in the comments. Guys who make comments in terms of asking questions relative to the lecture, I'll be happy to answer. If you got some nice comments, you think I'm doing great, don't worry, I'll put those up. What I'm trying to avoid with comments is spam. YouTube is littered with spam bots making crazy comments all the time, and it's just nuts. So all comments get held back, but eventually will be uploaded as long as they're checked and there's no profanity or anything else going on. The internet is very sad these days. In any case, thank you very much for asking those questions. I did try and answer all the questions I could. And what I'm going to do is I'll try and tackle some of those questions as I go through the lectures, because I did promise some of you guys that I would do that. Beyond that, should be an exciting lecture. All right. Before I delve into the meat of things, which I know you're all looking for, I'm going to ask you guys to bear with me a little bit, because there's something I wanted to touch on before coming into this lecture. Yes, I do have this point where it feels like a rant, but I promise you I'm not ranting. I'm literally just trying to give you guys the best direction I can, because I know most of you watching this are either new to market profile, new to trading, or new to building yourself your own strategies that you can depend on. And that's what I'm trying to give you here. My give or take now 17 years worth of trading experience should hopefully come to light through these lectures. I know some of you guys, if you've watched the previous lectures, you're already seeing that. And if you haven't watched the previous lectures, please go back and watch them. Because if you don't watch them, you're just denying yourself an opportunity to learn something that you're going to take for the rest of your life. What I'm doing here, no one else is doing on YouTube. You can look around if you want. There's no one else doing this on YouTube. I'm giving you a complete blow by blow lecture on things in market profile that you're not even going to see in an institution if you got the opportunity to go there. Because again, market profile gives you the template to build something of your own. Everything I'm teaching you here today is something I've had to develop over those years, and it's what's given me what I've got. It's put me at the top of the game. It's put me at the top of my own game, and I can guarantee you, if you know anybody who thinks they're a good trader and they want to do a one-on-one competition with me for 30 days and they want to trade against me, they can bring it. I'm pretty sure I'm going to wipe the floor with them. And all of that, I can say confidently because I use market profile and I know they don't. There are very few people who use market profile. I think it's like give or take 90-something% of all the hedge funds globally use market profile or have it available to use for their traders. And if you look at the retail community, I think that number is still under a good 5%, probably even aware of its existence, let alone use it. So you're in a commanding position, and I'm hoping through the lectures you've been able to see that you're in a really good position, and everything you do here and everything you learn is going to take you a very long way, and it's going to save you, if you're completely new, it's going to save you the dollars that you would spend on mentorships, tutorships, anything else, because it's not concerning market profile. And for me, if you're not being shown this, which is one of the easiest way to read a market, it's an easiest way to understand price delivery, it's the easiest way to understand volume, It's the easiest way to understand order flow. If you're not being shown this, that particular, whatever mentorship you're getting, is probably not worth its salt, right? Yeah, I'm sure you're going to get some benefits, but by and large, you need to know this. I think it's a part of trading that everyone needs to know. But getting access to a TPO chart sometimes can be challenging because it costs money. It certainly costs money, and there's no escaping it. I developed this for myself. This particular TPO chart, I developed it, I built it for MetaTrader 4 so I could have access to it. And I've said this before. I think, no offense if you're an American, right? Because I know a lot of Americans are going to be watching this, but I think US citizens are being robbed in the US, being pigeonholed into exclusively trading futures products, right? They're being pigeonholed into exclusively trading equities, right? They are not being introduced anymore. When I started trading in 2000 on the cusp of 2000 and in the end of 2006, 2007, that was my starting era, right? By the time we got to about 2009, CFDs in Europe had started to pick pace. They honestly weren't what you see today. And I often say this to new traders, is that if you were ever trading CFDs back in 2009, say even up to 2011, you're looking at, it used to take about a minute for a trade to get executed. So if you clicked to trade on the platform, you had a minute, and you used to get requotes, you used to get all kinds of crazy stuff. The industry was proper shoddy. I think it was worse than crypto. So CFDs naturally got a bad rep, especially in the United States, where they had a more advanced product called futures. But nonetheless, because of the availability of leverage, a lot of traders jumped on to CFD trading in America. And in my opinion, it was taking business from the big players, the CME and other people who essentially want you to trade their products. And as a consequence, a lot of people decided that, you know what, we can't have European CFDs in America, full stop, right? A lot of these firms at the time were being regulated in Cyprus under CySEC. I mean, we all know what CySEC's about, right? If you're European and you've traded with a broker before, everyone's got a CySEC license, fair enough. But there were a lot of brokers who had FCAs. There were a lot of brokers who had ASIC. There were a lot of brokers who had a New Zealand regulation, right? So generally, there were brokers who were regulated in trusted jurisdictions, right? At least jurisdictions the financial community trusts. Not every one of them was regulated in Seychelles, because again, there was no margin restriction or leverage restrictions in Europe. So for example, if you want to trade Forex now, it's 1:30 if you're a European. Or again, you can trade offshore. That's the benefit we have in Europe, is you can go to the same broker that has a European license and you can trade with their offshore entity. There's nothing stopping you from that if you wanted the leverage, right? But if you're, say, for example, you're a UK citizen, you don't have a choice. You've got to trade essentially with 1:30 leverage. But that wasn't always the case. That was as a result of what was called MiFID II. That brought in new regulation into the European landscape at the time. So the leverage ratios all adjusted. And there was, in my opinion, I think there was a lot of pressure from the US, who had already made the move first. And also it banned European brokerages from accessing the United States. So the CFD world became inaccessible to US citizens. But a lot of you wouldn't know this because some of you are quite young and you only started to trade maybe 5 or 6 years ago. And in light of that, some of you also found a lot of success trading. So it almost feels like that history didn't exist. But it did. Right? So again, I'm saying this to say that there's nothing wrong with trading CFDs or Forex. It's not any easier or any harder, and I'm going to prove this to you as we go through these market profile lectures, right? Is that it's not any harder or any easier to trade Forex than it is to trade futures. So for example, futures have what we call 1 cent bid and ask spread, right? But let's say you're trading something like live cattle. You're probably paying about $4 something, give or depending on who your broker is, around turn. $4 per contract, both sides, right? So to do that trade in and out might cost you about $8. Now, think about this for a second. This is no different to trading any of the other CFD products. You pay a cost to trade. Is that going to guarantee you're going to make money, that you've paid a lower cost in live cattle? Probably not. You still got to have some skill. Now, if you think about what it costs to trade Forex relative to the leverage available and the potential to make money in terms of range, how far the market can move, you start to realize you can just make as much money in Forex as you can make in some of these products. And some of these products are specialists. Like Forex, I like to think it feels like a baby industry when you think of it relative to futures. I mean, Forex itself didn't really come into being until 1971, after the Nixon depeg. So the truth is that Forex is fairly new, and it really only became super retail between 2009 and 2011. And it wasn't till post 2011 that we saw a lot of technological development in Forex, right? So most of the traders around today, most of them started in 2010, 2011, post 2008 the financial crisis, which drew a lot of people into trading because everyone went broke. No one can make money in property because property, well, if you're in the UK, to some degree in the US, most people were real estate guys, right? That's how real estate was the Forex. That was the speculation arena. You're flipping properties, right? Because you could get cheap credit to do it all over the world. In the UK, we're an island, so naturally, small island, lot of expansion, a lot of expansion of population. You start to get higher property prices. So in 2008, combination of cheap credit brought up a lot of what we call buy-to-let investors. Right, so everyone was in property, and then it blew up. Right, property prices crashed by 25%. A lot of properties went into negative equity. A lot of pyramid-type property guys lost all their money. I think nobody ever talks about that anymore. Right, but it happened, right? And as a result, a lot of people thought they needed a new game. And when CFDs came about, everyone turned their attention to things like Forex. And then binary options came along, and a lot of people lost a lot of money in that, right? Prior to that, everyone was trading the FTSE. It was index trading. So everyone would remember, well, some of the older folks would remember, trading the FTSE, right? Spread betting, we called it in the UK. So there's a history to this stuff, right? So all the talk today that you see of Forex is this or CFDs are that, trade futures are better than no spreads, it's bullshit. If you look at a Forex chart, you can barely see the bid and ask spread, right? And you pay a commission for the trade. It's no different from trading your 1 cent in futures. You don't get spread widenings, but you get a hell of a lot of slippage in futures. So I don't know what people are talking about. And take it from someone who's traded everything. I sell option premium. I've traded futures products. I have access to it. It is what it is. I've traded equities. It's the same thing. People got pigeonholed into equities. In the US, if you're a retail trader, you need 25K in an account in order to get over the PDT rule. In Canada, you don't need that. So back to the point. US traders are being shafted and they're being fed a lot of lies, and it's seeping into the trading community in general. Everyone thinks they need to be a futures trader. And it's killing traders, right? People are losing money in futures that don't want to say it. Because a lot of the futures products are they've got a lot of volume in there, a lot of professional types, a lot of decent algorithms. It can be very difficult to make money. So, but what I'm showing you here in these lectures, you're going to be able to see the angle. If you want to stay trading futures, you're going to see the angle to which you're going to make money. But every trader needs to know, regardless of where you are in the pond, that there is something called CFDs and Forex. There is a lot of leverage there. For an American, 1:30 will be eye-watering, right? Considering you get approximately 1:10 in futures, right? So that's 3 times the leverage in futures going into trading things like FX or CFDs. You can get the S&P 500 as a spot index. Yeah, that's a total spread. And that's it. No commission on that trade. And those spreads are pretty tight. Do the math on that. You think, I can get a little bit more leverage, then I'll take it. Can do more size, putting less capital as risk. I don't need to deal with margin changes. But for me, I like to look at trading. There has to be some common sense attached to it. You've got to do what's right for you. If you're a US citizen, you don't have access to CFDs, never mind, right? But I think there are American firms that are allowed to do it, right? But I don't know what the trading conditions are. I don't know a lot about that. But for guys who have access to European CFDs, so if you don't live in America, you live anywhere else in the world, you should not be trying to chase futures trading. Anyway, moving on. Right, so a couple of things were said on the last lecture, right? And sorry, thank you very much for sticking along. I think I spent a lot of time having this conversation, but I thought it was really important before I jump into the lecture itself. Right, so we did say some things in the last lecture, and one of the things we did say was that we're going to review every time we come to a new lecture what I tell you or what I show you, and then we're going to see if it came to fruition so we can have the argument, right? Bottom line, I'm not going to get everything right. I'm going to get a decent amount of situations right, because I'm looking at a superior piece of kit for analyzing price and market information, right? Price delivery and market information. I've got a lot. The kit I've got in front of me is second to none. Anyway, let's take a look at what we discussed. So if we recall for the last lecture, today we're going to cover a lot more as well on longer term, right? So we're going to look at how we build a profile on a longer term to be able to get into trades on that time frame. I didn't cover a lot of the cyclical stuff, but I did promise I will. And then in future lectures, we will jump into execution. I don't want to run into execution straight away. I don't want to start giving people execution models. They run out, they start trading, and they don't get it right, and it's all chaos. So no, I'm not going to do that. I'm going to give you the fundamentals first, and then we're going to jump on to what the execution model is that we can use in those circumstances. All right, so moving on. So here we can see that there was a bid stack, and I did mention this in the last lecture. I said that we've got a bid stack down here, and anything we're going to start to go short, deliver price into that bid stack, and then we should hit the stack, rebound, and then we're going to look for essentially run on sell stops or buy stops, depending. So I'm going to split some rotations now to give us some perspective. We can see that we've developed an upside bid stack, which we've overcome now. So clearly there was some bias down here as well. All right, so let's split and see what went on with both of these. And in both of these situations, I had positions. And I've said I had positions live, and I'll show you those positions. I had positions on prop accounts, right? Because again, that was a section that got interesting to me. I'm always up for trying new things. One of the things I've been doing this year is collecting prop accounts. I want to really see what this business is about beyond what people talk about all the time. Everyone's got a thing to say. I run a podcast, and I had a really big trader on that podcast, and that individual didn't know a lot about prop firms, but also equally had a bit of an opinion about it and thought that there were only a few good ones, they're not sure, all kinds of things. So prop firms, they start to have a bad rep, and I know there's terrible prop firms out there, but I wanted to investigate this myself. So that's been a new project for me, is collecting prop firms and doing those trades. So I've got trades on those as well, right? Those prop firm live accounts are racking up, right? Because I can always pass them. Not a problem. Those evaluations, not a problem. And I'll show you how to do that with market profiles. So if you're a prop trader, you want to be trading prop accounts, I'll show you how to do it but you need an execution model to do that. So that's not going to come straight away, but with market profile, you're going to be able to pass these fairly easily, right? And you can start to build a nice little nest egg for yourself using some of these guys, because my feeling about them is that they will only work for traders who can trade, right? Who've got a good model, highly disciplined. They don't need to be too subjective. But in any case, let's move on. So this is what it looked like. So you see, I think we still got some of the lines here from when we drew them out. This is today's current price action at the NASDAQ open, right? So we're going to take a look at everything. So we delivered price lower over the daily profile. So we got 1 day offer stack, bit more of an offer stack break off, gap in value. We can see that. And then we get break of the Asian opening range into the bid stack. And then we hold and we start to develop. Some of you, I think in the past lectures, if you go back to the earlier lectures, so again, I would implore you to start from the beginning. We did say that this moment we saw this move in Asia, this became an opportunity on the open of London. So we hit that London range open, coming at a bid stack, higher close, that would have been a long. And we can take that intraday through value, right? And then we come into what we call a value trade. And we'll talk about some of that tonight. And then we can look to cover that trade on the NASDAQ open, right? Again, we spoke about the liquidity drive in Asia. A lot of people wouldn't have been able to trade that. So we came down and eventually we did a run on stops initially under the NASDAQ open. So pre-market level. So this would have been, let's take a look at that, 1 p.m. So the New York open. We did a drive under in London, pushed up, and then we swept the London open too, pushed up, and that's where opportunity would come, right? So that's where my first trade was on the pound, and I'll show you that. So and then we'll look at the second one was as well. So we can see that quite clearly. That's one trade up here, and that's the next trade to the bottom, right? But you can clearly see that dill map is exactly what I said. So that was that sweep that we saw, right? So in case we missed that, that was that sweep here. And then you can see the entry because I was looking at the sweep. We can see the entry. It was a little bit higher, right? So that's me putting money behind it. And then we can see that second trade, right? That came at a slightly different price, right? So again, we saw that wash up and then we saw that second trade come down overnight into bids, and then we'd want to get on the back of that, right? So we can see that today on the Asian opening range move forward. But again, I was happy to take that at bids. So we went up in the NASDAQ, we went down in the NASDAQ, swept up in Chicago. I'd like to be long as we trail back into bids because we can see there was a run on stops. Right, so that was easy. So that was our liquidity model, right? And I did say that that would happen, right? The moment we had the up drive, it meant it was a good time, right? So you can see that trade again moving across today. We can see that done on my live prop account, MT5. You can see that drive as the price moved up, and then I covered it just before we stepped into the European Open, right? So you can see that now. So it's quite, and this would have been Asia overnight. So we can see that trade taken on the break at Asia and then one up, right? So these are all live trades, right? So these are trades that have contributed to my profitability on this particular position, right? And it's clear for everyone to see, right? So you know that I take the same positions I'm showing you. These are the same positions I would take. So I'm not showing you something and then doing something else. I have different execution models. Any good professional trader should have that, and they probably would. But all of it is based on what I see on the profile. So it works, right? You can clearly see 3 positions being developed, and you can see where they went and where they closed out. all with good risk to reward management. What would the trade look like? Again, if you were getting long here, you entered at the close. This should be below the lows, again on a drop of bids, and you wanted to develop another position in, so you wanted to add, as we dropped into bids, you could add stops at the same place. And we'll talk about that in money management, and then we look to see we're either going to try and get out as we reclaimed a high, but for me, I knew that we were looking at the fair price or at least trading back into the offer stack. So for me, I'd want to be out into the bids, into cover the gap in value. That would have been a really good trade. And that's what I was looking for, is to cover the gap as opposed to ride the fair price and the offer stack. But again, there's nothing wrong with sitting just below the offer stack. It was the likely place the market was going to drive to, right? Again, if we're going to break that offer stack, then it would essentially mean we're going to drive for the liquidity above the daily liquidity. And we're going to look at what that's potentially going to look like. Right, so this again was an opportunity, guys. It was clear as day. There, everything lined up. We had liquidity, we had time, because obviously we're trading off a major open, that was Chicago, and we had the volume to back that up. If I close it, you can see that we had volume here, and we had volume down here. So there was a lot of evidence to suggest that it was build up. This breakout was pretty much expected. So any trades that were done as we rode above value would have been pretty much where you'd need to be. If I split this, you can clearly see where the opportunities were. We had a break at Asia, moved up. Yeah, and you can see us initially fail to take out any liquidity at the highs, so there were no run on buy stops. We pulled back, and where did we go? We went straight back into the bid stack. So quite easily, you could have, no matter how late you were on this, you should have been able to visualize this stack. So even if you were catching this on the pullback into G period, you'd be looking to be a buyer at this point, right? And then you can look to cover a bit more range, right? So you can cover the lower the day. That's where a lot of the stops are going to rest. So all those sell stops will be resting low of day, and that's what you want to pay attention to, right? Or low of previous day, right? So these are all going to be significant lows, and we know what's sitting down here. That was where the Chicago traders did a run on those sell stops. So that's going to be a tough level to catch within that intraday, right? So that would have been a good trade, and we can look to push that. That trade went to 81 ticks. You had about 29 ticks of risk. We went to 81, and that was the London Open, right? The European Open, and then we failed because we were overextended, right? And we'll talk about concepts about range associated with profiles as we go through the lectures, but we're not going to touch on that right now. So you can see that here. Perfect opportunity to get involved in what was crazy price action. What's happening now, right? Back to the right side of the chart. I love being on the right side of the chart. You can always tell people what happened on the left side. The left side is for our volume references. We want to see where things were past price action, but that's not where our focus needs to be. Our focus needs to be on the right side of the chart. So when the NASDAQ open now, we're about to close the NASDAQ hour. What we've seen, we run into a sell stack or offer stack, my bad. We run into an offer stack, right? And we can see already we've had a push, we've had a draw, right? We had a draw on the high. So if we split this, we've already had a draw on this liquidity. So if we close under and we take out the Q period low, then it's the perfect opportunity to get short back in for the bid stack, right? There's not a lot you can do, and your stops can be above the high, right? Because we have a bid stack here, it's a riskier trade. We have to be able to chew through it, which I don't believe we're going to do today. But it could be an overnight trade into Asia where we could push into that, and then you could break even and then see if we respond to it or we go through it, and then we take out the liquidity at the low. So it's a perfect opportunity to drive this maybe back down underneath the prior day low. And if we get that, we're likely going to get a bid stack. Again, A retest of this bid stack might not be such a great thing for that bid stack, but again, we could retest it a second time and rally back out. But we first need to see if we take out the low of Q period, and that would probably be a really good signal that we'll probably go lower. For today, from what I can tell, it seems like the highest volume of the day is sitting at the highs of the London session. Again, for me, I like to call this a poor high. There's every chance that we could break that. If we fail to hold within the price area of between D period and let's say O period, we need to be down here for us to have confidence as this thing's going to go lower. There'll be plenty of opportunity to find a trade if you were trading in the US session and you wanted to look at potentially shorting this. But note, the same rules apply. Nothing has changed. Same deal. So that was cable, right? This was crude oil, right? We had a talk about that. Right, let me zoom in a little bit. So again, this was crude oil. I have some levels marked here, and these were all the levels we were inspecting. So there was a bid stack down here. You can see that clearly, right? So we expect there will be volume, and let's expand this out. Same deal. We had a run on sell stops above these highs, broke down, closed in. That was naturally, we're going to come and do a run on, we had a run on buy stops. We're going to come and do a run on sell stops. You can see that quite clearly. We came down lower, and this was a crude oil trade we spoke about at the time, and we said that this was a trade that we would want to do. We came down, we hit it initially, right? And we thought we would be able to get along here. Didn't. We traded the low again, pulled back up, and then we held. For me, this was another good opportunity to get in. Again, we can see that moving K period, that run on the sell stops underneath D period. That would have been under the New York 130. A pull back up, and then a hold in after hours. That's about 5:30. At that point, we are looking now to get long, stops below, because we've seen a run on those sell stops. We also trading in a bid stack, and by M period, we were closing above that. That was about 6 p.m. There's nothing wrong with you getting a trade in here, looking for us to drive initially the end of day high, and the open of day high, my bad. Right, so we need to be up here. We could also look at this level, and then finally, I would think we were going to make a complete run to go and look for what? Above the highs? Well, this was an offer stack, so we're going to run and look for buy stops. And that's what's happening now. What's been the response to that? Again, we can see that drive above, close below on E period, huge flush. And this is, again, our time equation is coming into play. There's liquidity for sure, because we just did a run on buy stops, and you can see that flush down, right? That strong close on E period. There's nothing wrong with you getting short on the break of E with stops above, right? What we're looking to do, well, obviously we had a gap in value initially, possibly fair price. In my opinion, we're probably going to start to make our way back down to see if we can take out some of these levels. At least that's where my head would be. Again, failure to do that would assume that we're going to take the buy stops at the U period high. Absolutely no different. Now, can you tell me, let's close this up. Can you tell me the difference between this and a Forex chart? What's the difference? There is none. So there is no argument that for some reason trading one asset is better than the other. No argument. These markets are doing exactly the same thing, and they're doing exactly what we expect them to do. Exactly the same thing. They're not doing anything different. So getting hung up on maybe trading a different market all the time, just pick one. And again, I'll teach you in future lectures what you look for to pick. But essentially, there are only a few criteria looking for. You need something that essentially beats dollar deflation. That's it. So that inflation in the dollar monetary supply, which kills the value of the dollar approximately by 10%, 12% annually, right? You need something that beats that. And that's a trending asset. So usually gold fits that criteria. Bitcoin, a couple of the assets that S&P 500 all fit that criteria. So equity indices all fit that. You can trade with some of those guys, not a problem. If you're doing things like crude oil, these are cyclical assets. So people are going to algorithms are going to look to trade buy stops and sell stops in the same way they do currencies. There's absolutely no different. And look at how that oil price is chucking it right in front of your eyes. This is not me making this up now. This is doing it right in front of you. You can see it going down. And if you'd followed that, you were in the short on this, on the open. As you can see, I've already had my trades for the day. I don't need to be in this move. But if you were looking to get in a move today with crude oil, this would have been a perfect level, is when we ran those buy stops up here and then we close lower. Clear as day. This is 2 p.m. NASDAQ, right? This broker has a 2-hour shift. So it's 2 hours ahead. This is a Cypriot based broker. So it has 2-hour shift. It's 2 hours ahead of London, but it's 2 p.m. in London, which means it's a 9 a.m. in New York. And you can actually see that when the NASDAQ opens at 9:30, it contributes to the move in crude oil. That's because they're oil ETFs and they're things that take their cue from crude oil. So you're going to get a lot of movement in the commodities in a major center open. So it fits our time criteria. 2 p.m. major center open. We've seen liquidity run on buy stops. We also have some volume backing that up because there was an offer stack here. Perfect. It's like all the stars aligned. You should be in this trade, right? And now all you do is hold and wait and be patient. There is the volatility here. Right, again, when you look at that at the break of the F period low, we're looking at 49 cents, 50 cents, right? You're already 65 cents up. So you're already more than a 1-to-1 at this point. Now, all you need to do is see a decent drive to about a point. You can get out of this trade. That's a 2-to-1 already. Again, if you're looking where it's going, potential to go, there's going to be liquidity resting underneath this level. That is a logical place for price to deliver to before we get some relief. I would expect that we're going to trade to the low of that. Right? That would be probably the end goal, is that we're going to see a move in the next subsequent rotations that will take us to the prior day lows, right? And that would be a good place to consider getting out. So you can stagger your exit. You can make it a total exit at this point, right? There are various different ways to money manage, and we're going to talk about that at some point. Again, would I get short now? Hell no, right? I wouldn't. It's too far, right? We have to take into account we want the best possible price when we can get it. If I'm short, I'm too short in the hole. It's too deep. What then happens if it goes back up? Where do I put my stops? There's a lot of things to consider. So I'd rather wait for the turn than get in on the trade now. Really important. So being patient is super important. So we've already seen that with crude. Look, it's no different, right? I can go for a ton of assets and we get the same, but I figured we covered these now to cement some of the concepts we've been learning over the past couple of lectures. That's understanding how the pricing algorithm keeps delivering prices across different markets. They're mostly the same. With a few nuances, the algorithm does the same thing. And us understanding that is super crucial. All right, so let's move on. So today, I'm going to talk to you guys about how we assess the longer term frame. Right, this is really important. A lot of people struggle with trading shorter term frames. It's largely because they don't understand the longer term frames. So we're going to talk a little bit about that. So we're going to go to the left side of the chart because we've talked about the right side of the chart already in the previous lecture. We've talked about this development. Because it's a longer time frame, this is a weekly profile now. So drop that. it is a weekly profile, so you can see that here. So it means that we're looking at everything week to week, and we've just started a week today, so we've essentially gone from value low to value high. That's where we are for the week. Not a lot I can do about the right side of the chart. Only I can say that we did an initial run on buy stops. We came down, we filled the gap, hit the bid stacks as expected. So again, if for those of you guys who followed the last lecture, and if you haven't, please go back and do that. Do not deny yourself the opportunity to see these things before they happened, right? Because I said it before it happened, that we're going to trade lower. Now, if we split this rotation, you can see we're going higher, and where are we trading now? So we can see where all of the typical sell stops or buy stops are likely to rest. I keep missing my words on these things. Sell stops, buy stops, sell stops, buy stops. Okay. So we can see that where it is, we can see that we went up. We had a bit of a draw, but we failed at this point in time to close within this price region here, right? So we haven't closed we haven't closed underneath the stop level. We just haven't, right? We bounced and we're going higher. So that's giving us the indication that we're going to see higher prices. Likely we're going to be looking to head for the liquidity here, most likely here, right? And that's going to be interesting. It's suggesting that we could see higher prices, but we're not going to speak too soon. And that's the thing when we're looking at weekly frame. These are 4-hour rotations. We have to give it some time to see if we do come back and close under the E period low. If that was to happen, it will indicate that we've gone bearish very quickly, and then we're likely to start to deliver down to the low of the week, right? And that will be a little bit different. It means that we're likely to seek the liquidity down here, right? Again, if we're going to go much lower on a weekly frame, we would need to close underneath, in my opinion, this bid stack, or at least back into it and then hold and then do an opening range that will take us under, right? It's a lot of work to do for now, right? So we're not there yet. That will be the expectation. But for now, we have not seen that. So let me delete some of these things. So we have some new levels that are going to be of interest to us. First, there's going to be this level here. We're going to look for what the weekly profile does in relation to this level here. Are we going to go through it, create a draw, and then come back down? So we're going to pay a lot of attention to this level, because that's where the market is likely to go and generate interest. We can see, based on the shape of this distribution, that there were offers sitting here. So this is a stack on the week, but this is a much bigger stack, right? And we're trading above it. So we're not going to lose sight of that either. So for me, there are a lot of people crowding at the top of this market, right? So people are going to get punished sooner or later, right? So, but we have to be patient. So we want to see what the market does at this level. So in order for me to show you guys anything reasonably meaningful, I need to go back to the left side of the chart, right? I'm not going to go too far left, right? I'm going to get as relevant as possible. So, people don't accuse me of being too carried away with the right side of the chart, with the left side of the chart, sorry. Right, so first and foremost, this price action here that looks like a consolidation was a series of opens, lower closes, open, higher close, open, higher close, right? So there was a bit of trading. So from a candlestick point of view, this would have looked like, let me see if I can find some of those shape tools to give you some perspective, right? So that would have been the open to the close, right? So this would have been your candlestick bar, right? So this would have been a tail. We can see where value was, and we can see where the stacking is, right? So this clearly identified itself as a bid stack the moment we started the trade in C period on this price. So if we split this C period immediately, that gave you the indication that this was largely buying, right? So let's close this. Right, so, but that's what it would look like, right? And then if we look at this one here, again, that would have been the open to the close, right? This would have looked like a lot of sell pressure and a lot of pressure down here. What you wouldn't have been able to see, so again, if we did, let's divide all of this now. So let's say you couldn't see this price action. What you would have been able to see is just this, and a lot of people who didn't have access or don't have access to market profile would not have been able to see the bid stack that was down here. Let's draw it up. They wouldn't have been able to see this, right? So it would have been easy to make the assumption that this market is just going to tear lower. But if you saw that there was a bid stack here, you would have said, okay, maybe that's not going to be the case. Maybe we're not going to tear lower despite seeing what looks like sell pressure. Maybe we're going to support here and then we're going to come and try back the upside for some liquidity. And that's what that would have looked like in this week when we started to tear away. So if we split this rotation, that's what that would look like. So we opened the week, we could see the bid stack. Market immediately moved higher at a weekly open. So the first 4 hour rotation, opening range break, we move up, we hit what looks like an offer stack, come down in E, right? But we don't keep going lower. We don't even take the liquidity at the Asian low and we close higher. So already the market is showing considerable weakness. So what do? We drive above the E period high and J period, hit this offer stack here and then pull back in. So again, we knew immediately once we started to trade under, right? So we came down, held, and then finally closed in our period. We knew that this would have been a good sell price, but we can only drive to the bid stack, right? So that's about 119 pips though. So we could have been short here. We had stops above here or here, 69 to get about 120 ticks. So it's not quite a 2-to-1. So we knew that this was going to be a tight week if we're going to look for shorting opportunities against the week, just because we got a bid stack here. And by this point, the week was almost over. So there was probably not enough volatility there to keep driving this for the rest of the week, more or less. So there's going to be a restriction in range. And I'm going to talk to you guys about range to go with profiles, but I'm not going to cover it in this lecture, right? I'm just not going to have enough time, right? So perspective, guys. That's what a profile gives you. It gives you perspective. So if I know that already, that's where my target's going to be. I can't force it to be further out without exposing, myself to more volatility and risk. Right. So point in case, right? So I've used on the left side to give you an example of how you can now start to build a thesis from a longer time frame, but also having access to a shorter time frame through the rotations. Because this is a weekly profile. When we split this, we see the 4 hour rotations, which means we can trade in the week without actually needing to swap time and swap profiles. We don't even need to look at a daily profile. We can do the same trade in the week, but take account of the trade moving across the week, which allows us to carry the trade forward into multiple plays without actually thinking that I need to look at another chart and another chart and another chart. You can just do it all in one. So this period here where we were dropping was giving indications that buyers had not finished yet. Now let's split this rotation here, right? And what do we see when we finally get into this week here? Again, we can see that down here, there was the opportunity for us to draw on what? I know you know it. Sell stops. All right, so we're going to draw on sell stops. And when we did that, it became evident that's what we were doing. Because C period, huge move, boom, close. D period, huge move, boom, close higher. Immediately, we know that we're already hitting stops. That's why we're getting this price action. What are we looking for? Let's just get a nice tidy close back into this price area. That's all we're looking for. Why does this happen? I know some of you are still asking this question. I think I spoke about this briefly in other lectures. But the reason why this is happening is because traders place their trades randomly, and also they put their stop losses in areas that they traditionally know are the best places to put it. And we all can't avoid it. We need to have some protection in. And the algorithms know that. They need to access hidden liquidity, which is stop orders, because those are market orders. No one else knows where these orders are, with the exception of the broker, who will sell that information to a HFT firm or someone who designs these algorithms. Now, if we know they're going to do that, it means the algorithms know where to generate the most liquidity when clients need it, right? So those bigger traders that need bigger volume, they know where to find that liquidity. So if we know this, if we have this information, we just need to imagine where everyone will put a stop. Now, if you were long from the open of the week, which is a good place to be long from, if you are a large trader and you're carrying a trade through, or you're about to get into a position, your best bet is, if you're bullish, is to get in on the open, right? You're probably going to look at the opening price as a significant level. So let's say you were long here on the open, and then price action was driving. You are going, as you make your money, you're going to start to trail your stop loss. So by the time we closed here for the week, there are a large number of traders who would have put a stop just at this level. And these are going to be guys who've already bought, and they're going to be 109 pips in profit at this point. And they're happy to take that. So they're going to put a stop there to say, if the market comes there, just take me out of this position. So sell me. And if you're going to sell someone, then you're going to have to sell that position to someone else who's going to buy it. And that's why we get these runs. Because if I can trigger these sell stops, I get a good price, a good position for nothing. Basically, I get a good position for nothing. Someone is sold to me, so they've come down to the bid, right? So I'm not having to buy at the offer. They've come down to the bid and they've sold to me on the bid, right? So I can grab that straight away. And that's pretty cool. And that's why we get this. So as soon as we come back into this price area region, I know that business is done. So now you can say, well, I'm going to get longer I period, and the natural place to put stops is going to be under the F period low or the D period low. Most people go with the D period low. That makes a lot more sense. And then as the trade works, they'll trail the stop to the F period low. And now they've dynamically adjusted their risk reward. Right? This was a high probability trade. If it had come against them and taken them out, then either way, they were still on track, because this was a 144 tick move and they would have had a 77 tick stop. So it's not quite, a 2-to-1, but it's nearly there. So ideally, if a trader had taken into account the volatility on a week, they might have said, well, I'm going to keep my stop tighter, let's say 60 ticks, right? Give it some wiggle room. And then I'm going to drive for 124, 25 ticks. That would have been a sensible move, right? And that takes us through value. So we expect that we're going to start to see interest from selling at value high. So it's going to be crucial we talk about value areas very soon, right? I've been putting it off, but that's coming, right? And this is a real bread and butter of trading the profile. So what do we see? We see that draw on liquidity in the week. So this would have been early in the week, Monday rolling into Tuesday. And then we see that close up Tuesday rolling into Wednesday, Tuesday almost rolling into Wednesday, but Tuesday still. And then we see the drive. Right. So it's immediately told us that, so if we close this up, now that we can see this, what do we have? We have open, higher close, lot of tail action with what looks like a draw on sell stops. So if I'm correct, we've seen a complete close of the week. The next move up on the week should be higher, and that means that we're going to take at least a high of the week. So we should start to see a draw on buy stops for the week. Now, if I have that information and we're opening the week, then very easily we can look at where we open the week. In this case, we open at the lower deviation, right? So the lower part of the fair value the fair value area, right? So where the prices are the fairest. This becomes a good trade to buy at the open, have your stops underneath what was a legitimate bid stack, below value low. All of these are good areas of reference. And then we want to go long to catch the liquidity against the week. So that gives us a good way to plan our trades into the week without having to default to the intraday time frame. Because I'm well aware some of you guys want to swing trade. You don't want to do the intraday stuff, and you don't have to. But so this is a good way to plan it. But if you want to kind of maximize on your opportunities, maybe, like I said, I'm a believer is trade small, trade often. And that gives you a lot of data set. When you're doing trades like this, you can only do them when you have more experience, because with experience, you've been able to get a lot of data that allows you to sit back and relax with your positioning. This is not the luxury of a new trader who doesn't have any information, no data. So you need a lot of practice and you need to see a lot of behavior. That means you've got to trade more often. The only way to do that is to trade a slightly smaller time frame. In my opinion, that's the intraday time frame. So you should be working on daily profiles. In other words, what can we see below us? We can see a gap in value, right? So we also know that at some point there is a huge risk of the pound falling all the way back down to 129.45. It's a massive gap in value there. If this market's going to be efficient, it needs to close that gap. And in all my time in trading, I've never seen a gap that wasn't filled. So I'll keep warning about it. And when it happens, we'll all sit here and see it in all its full glory. And hopefully it happens through the series of these lectures that I'm going to be doing, which I'm going to be doing for some time. So this is going to be a massive teaching framework across the year that hopefully will build you guys the kind of experience that you need to start digging your teeth into this and stop listening to the BS that's surrounding the internet. That's why this is on here for free. I'm pretty sure I'm the only one doing this right now, is talking about market profile, time price opportunity charts right here on YouTube. Right? People pay, I think there's a firm, don't quote me on this, there's a firm on the internet that does like things around ladders and order flows and all kinds of things. And that firm also has access to TPO market profile. And that firm is asking traders for 5 figures to learn with them, doing exactly what I'm showing you now in YouTube. Okay. Look around if you don't believe me. You'll see them. They're all there, asking for thousands and thousands of pounds. Some of the platforms that have TPO ask you for hundreds and thousands of pounds every month for these TPO packages, right? I have this available if you're interested in having a TPO. I mean, the data, and again, I'm going to reiterate, I don't care if you trade futures, you trade, you're a citizen who wants to trade futures, blah, blah, blah. You can still get a demo account from any of the European CFD brokers. You can still install a TPO chart on it, and you can still get the Dow Jones, the S&P 500 pricing. Look, I've got corn, for crying out loud, right? How many of you guys trade the agris? Not a lot of you, but I've got access to a corn feed for free, right? For free. It's the end contract, 2025. I've got it for free. I don't have to have another feed for corn. So if I wanted to trade a futures product, I can still trade the futures products by visualizing my market profile and taking those opportunities, right? And we did discuss, by the way, this run up in corn, that we were trading this level, we're going to draw on liquidity and we're going to push higher. So you don't need like all this complex stuff, just don't need it. I can't reiterate this enough. I've got the NASDAQ on here. We spoke about that too. I've got the Dow. I've got everybody. I've got gold. Why do I need to pay $1,400 a month, whatever it is, to get TPO? Why do I even have to pay $40, $50 a month? So if you want access to this, let me know. I am more than happy to give you access to it. It will cost you. TPO is not free anywhere. I need to maintain the service to run this for everyone. But I'll be able to activate that for your MetaTrader 4 demo, wherever you get it from, and you can use this to do your trading. You can have this on one screen, you can have your charts on the other, and then you can still do your trading as normal. You're still going to get the prices you want. You're still going to be able to make money. Nothing will change. But if you're interested, join the Discord server, link in the left, DM me, I'll give you access. Not a problem, right? Or you can go spend your money, like I always said, go spend your money with this, the firms out there who offer this. There are quite a few. Not a problem if you want to do that, but it'll be way cheaper for you to take this route and you'll still get the same thing. Don't let anyone convince you otherwise. All right, moving on. All right, so again, like I said, we'll be able to watch this, hopefully, occur in all its glory when that point does happen. But for now, we have to settle with what we're seeing. And just as I was saying to you about a few minutes ago, that it looks like we're going higher, and the level we should be paying attention to should be this level. I think I've covered a lot today. I've touched on a few things, touched on elements of money management. I've touched on ranges, right? Things I'm going to cover more in depth. I think I'm going to focus a lot more on ranges, value areas. I've covered trading on a weekly profile, not having to even go to the intraday and still find yourself in a good position where you can make money. 100%, right? We've gone over the stacks. They're the same. They look the same on every market. Don't just, not because you see a market going down, don't just assume that it's going to keep going down. We want to see a nice clean hold if we're going to accept that that market's going to go lower. Respect bid stacks, right? This is real volume, guys. Respect it. If you see it, take a minute or two to think, what is this market going to do against all that volume? We have to consider it. Learn to split your rotations from time to time so you can see where that resting liquidity is likely to be. Don't ignore gaps in values. They always fill. In currencies, very efficient market, they're going to fill. You're more likely to see them sticking in like things like the Dow or the S&P because those markets are a little bit different. You know, they have this, I like to say they have the Fed manipulation on their side, right? So their manipulation of money supply is allowing these things to inflate, and often gaps can stay unfilled for weeks, months. Recently, we've seen a major gap fill on the S&P 500. That was crazy for a lot of people because they weren't expecting it, but I was. And again, as we in future lectures, as we look more and more at this stuff, I'm going to show you where those gap fills were, those big levels on the S&P. It's the only time you're going to see me go to the left of the chart when I want to show you some of these occurrences so you can see that, you know, this is what it is. It's not going to change. It's something you can do consistently for as long as trading exists. It doesn't matter how many machines or quantum computers they put in, price will always deliver like this. It's not going to change. Always going to be the same. Okay, so another lecture down. I look forward to seeing you guys in the next lecture. Any questions, leave them in the comments. I will answer them. Doesn't matter what video you leave the comments on, I'm going to answer them. If you need to get in touch with me directly, Discord link, bottom left, been flashing for the whole time. All you have to do is put that link into your browser and it will ask you to accept the invite to join the server, and that's it. It's completely free. I do have a private members area, but browse around what I do in the free area. There's a lot of content there already, going back years. This server's been around for 2017, 2018, can't quite recall, but it's around about those times, like 2018, 2019, I think anyway. So it's at least 6 years old, right? So there's like a ton of content in there that go back for 6 years, right? Everything I've done, everything I've looked at, it's just so much stuff. It's unbelievable, right? And you don't have to pay for it already. So if you want to be private members, get access to trades, positions before they happen, that other kind of stuff, then yes, you're going to have to join my private members area. But start with a free, see what it's like. You've got YouTube as well. So there's a ton of stuff for you. And even if you don't feel like you want to spend your time with me, it's okay. I don't mind. You know, I trade for a living, so I'm always going to be here doing this. So whenever you feel the urge and the need that you need someone who's solid, who's going to be around you for a lot to mentor you as you go through this journey, you can ask questions. I'm here. I'm a friendly guy. I like to think I'm a friendly guy, and I will always be there to kind of help people if they need the help. I know how tough it is. I know this business can be crazy. New people come in and it can be really difficult. right? So I know, yeah, a lot of people get like a bad rep for trying to help people to do stuff, and they say, oh, yeah, you're just trying to, it's like there's something inherently wrong with being entrepreneurial. Like, oh, you're just asking traders for money. I'm fine with people asking people for money as long as they're showing them something legit that's going to help them through the course of their trading journey. If you're doing that, I don't have a problem. People should pay for that stuff. Jesus Christ. This stuff has been life-changing for me. Why would, yeah, we'll want an element of being a good Samaritan, but, it gets to a point where you're like, this is capitalism. Jesus, if I've got all this information and I've taken the years to build it, I shouldn't really give you for free. But yet, here I am, right? So I'm not going to give you everything for free. That would just be freaking ludicrous, right? So there's some things, if you want them, and you want that extra time, and you want that extra knowledge, and you want someone to mentor and focus you and hold your hand literally, then you've got to pay for it. And if you can't, then you should make do with this, right? This should help you, but you're going to have to do some legwork yourself. You're going to have to go back test. You're going to have to look at execution model. You're going to have to test things. Even if someone's mentoring you, you're still going to have to test things. But obviously this means that if you don't have someone holding your hand and mentoring you literally, every single week, where you have constant access to them all the time to answer all the billion questions you're probably going to have, right? Run ideas by them. If you don't have that kind of accountability buddy, then yeah, it is what it is. You're going to have to put in the legwork, and that's what comes with doing some element of DIY. But I will provide you with the tools for you to be able to succeed, and I'm invested in your success. So if you feel you need to reach out, please do. If you don't, then again, this is all available to you. Till the next lecture, guys. Adios.